Fintech in India is a $600 billion market as of 2023. And if you were to know the broad categorization, so the lending companies or the lending techs comprise 40 to 50% of the market. The second would be the payments tech or the payments companies, which comprise roughly 25% of the market, followed by the insurtech companies, which comprise 15% of the market, followed by the neo-banking companies, which comprise 10% of the market. The last two would be the investment tech, which comprises 2% of the market, and SaaS companies or the fintechs, which comprise 1% of the market. These are the broad breakup of the market. And as you can see from this, the main or the most value lies in the lending tech companies or the lending fintechs. So, hey everyone, CA Vaibhav Jain here, and today I will discuss with you how lending tech became such a big concept and what is the reason behind the dominance of lending companies or the lending fintechs in today's world. So, for that, I will discuss with you how a traditional lending model works, which would comprise your banking and NBFC companies, followed by why the need for lending fintechs arose and what is the difference in their business model vis-a-vis a traditional lending model. So let me start my discussion by taking the example of a bank or a traditional NBFC. Now, these banks or traditional NBFCs tend to take money from multiple sources so that they can lend to their end customers or the borrowers, right? Now, you have to understand the sort of arrangement they have. With the customer, they will charge the customer some interest, so the customer will pay interest to the bank, and the bank in turn pays interest to their own borrowers or the lenders from whom the bank in turn takes debt, right? The bank might also raise money through equity on which it does not need to pay an interest cost. So if you were to look at the balance sheet, so in case of a traditional model, the balance sheet would simply look like this. Whatever loans the bank has given would be on the asset side, and that would be funded by either equity or by debt, and this would tally your balance sheet. Now remember, whenever I talk about debt, you also have to assume that debt includes your deposits from customers. Why have I clubbed these two? Because on both of these two, the bank has to pay interest, and hence I clubbed both of these under the debt head. So this is how the traditional balance sheet of a banking or an NBFC company looks like. And if I were to talk about the profit and loss statement, so you understand the business model. So basis that I will just discuss quickly with you. There will be an interest income which the bank would earn from the customers. There would be some processing fees which the bank charges to the customer, and then there would be some interest cost or finance cost which the bank has to pay for the own borrowings, for the borrowings which it has done. The net figure would be the net interest margin from which the bank has to do it operational expenses or the OPEX. The bank will have to bear the credit loss or the provisioning and write-off, and that would give the bank its profit before tax or PBT minus taxes, and you arrive at your PAT. This is how a traditional or a normal profit and loss statement would look like. Now, if I talk about the traditional banking or NBFC models or the traditional businesses, they tend to cater to a different segment of customers compared to a fintech. Let me explain. In terms of customer persona, there can be multiple types of personas. There can be personas based on profession. Either they can be salaried or self-employed. The customer can be broken down in terms of their credit score or the credit history. So there can be high credit score people, there can be medium credit score people, and there can be low credit score or new to credit customers. So high would be say 700 plus. This would be somewhere in the 650 credit score range, and these would be somewhere who do not have a credit score, so new to credit. Then there can be other sort of bifurcation as well. Let's say in terms of geography, right? There can be urban or metro customers, there can be rural customers, there can be tier 2, tier 3 city customers, right? So there are multiple types of customers, but one of the main bifurcation was this credit one. Ideally, in a banking or an NBFC structure, the most preferred customers are the high credit score customers or customers who have a high propensity to repay the loan, followed by the medium customers. But these particular segment, the low and NTC customers, were not catered to by the traditional route. And this is because of which the advent of the fintechs came into play primarily. So let me just do one more layer of discussion on this. If I were to talk about these customers, let's say we have our 700 plus or the high credit score, we have our 650s which are the medium, and we have our low credit score customers or the two which do not have a credit score. Now, because if I talk about the credit risk is low, medium, and high. So therefore, just a second, I'll move this down. So therefore, depending on the credit risk or the default risk of the customer, the interest charged to the customer also varies. So because there is a low credit risk, the bank gives loan to the high credit score customers at a lower interest rate. And for those with a high credit risk or a low credit score, the interest rate is high, right? And this is how the fintechs have come into play. So if I were to talk about the profit and loss per se, the traditional banks and NBFCs used to operate by giving interest at a low or medium rate, whereas the fintechs come and give loans at a higher interest rate. Let me explain how. Whereas a traditional business or a traditional model was okay to give loans at 10%, these new age fintechs have come who give loans at 20-25% interest rate, right? So let us take 20% as an example. Just a disclaimer here, whatever numbers or percentages I'm taking, these are actually available in the industry. I'm just taking a rough average of whatever happens in the actual industry. So in the traditional business, the loans are given at 9% to 12% of range, and in the fintech world, the loans are given at starting 18% up to 35% of rate, followed by the next line item, processing fees. I will discuss processing fees after later on, but let's come to the interest cost. Now, as I told you, in the traditional route, these particular NBFCs or banks are allowed to take deposit as well, right? So because they take deposit from their customers at lower rate and they have a better scale and I should say they are in a better position. So they tend to get loans at a lower cost of fund, and hence their interest cost is quite low compared to a compared to a fintech model. So if I were to talk about a traditional business where they are able to get loans at 4%, a fintech on the other hand might not be able to get loans below 12%. It is in the range of say 10 to 15%, but I'm taking 12% as a rough average. Okay. Now let's come to the processing fees now. Processing fees is charged whenever a loan is given to the customer, as you're aware of. Now, in a traditional banking route or a NBFC route, they do not tend to take too much money on the processing fee. So they charge roughly 0.25 to 0.5% as a processing fees, which means they have roughly 6.5% NIM. But in a fintech, they actually tend to charge a very high processing fees because they actually tend to earn because of the processing fees. I'll explain how. And that is the main reason because of which they have a higher processing fees of let's say 3.5%. Again, there is a range, The processing fees is between 2 to 5%, but I'm taking an average. So that leaves them with an 11.5% NIM. So if you look at this, where a traditional business was only having a 6 to 7% NIM or a 5 to 7% NIM, a fintech on the other hand will have a 10 to 13 or 10 to 15% NIM. So fintechs generally tend to command a higher NIM. But this is not all happy dory. But the reason is that they have to have a higher margin because they will also have to bear a higher credit loss. I will explain why. If I come to the credit loss directly, as I told you, fintechs generally cater to this segment. I'm not saying that they do not cater to this segment, they do cater to this segment, but their majority game lies in this particular segment. So here the fintech presence is low, here the fintech presence is higher because there is a wide space which they have seen. The traditional route does not cater to this segment that predominantly. Sorry, uh, the traditional route does not cater to this segment that predominantly, but they do love this segment where they have a good credit score, they have a low credit risk, and hence the credit loss for a traditional bank or NBFC, whereas might be 2%, that for a fintech is very high. It goes as high as 5 to 7%, even 10-20% in some cases, but I'm leaving out the outliers. Okay. The one of the line items which is now left is the OPEX. So let me explain to you how the OPEX looks like. So again, under a traditional route versus a fintech route. How do traditional models work? Basically, the banks or NBFCs open branches at multiple locations. Then these branches have loan officers who try to either fetch customers or whoever customer comes, they try to underwrite those customers. Whereas in a fintech, there is no branch. Branch presence is not there. They only have a head office and they might have smaller offices, very small offices, or even not an office but a person in the city wherever they have. Because in their cases, the underwriting or the loan underwriting happens centrally. And hence, this underwriting happens at the HO, so they do not need branches. That is why within the OPEX for a traditional NBFC or bank, there will be branch concept, but for a fintech, there are no branches. So now let's just give some OPEX numbers as well. Let's say um, maybe a 2% OPEX for a traditional bank versus I don't know 3% OPEX for a fintech. Let's put these numbers for the time being. So net interest margin minus OPEX gives me my pre-provision operating profit or PPOP. So I get a 4.5% here, and here I get the 8.5%. Surprisingly, 2.5% PBT I am getting, but again, this is not the whole truth. It can vary across companies. Taxes are 30%, so 0.75%. Let me put 0.8%, and we get to a 1.7% PAT or 1.7% ROA. Okay. One more thing on the OPEX thing. What all things are included in the OPEX? One is the employee cost. One, as I told you, for traditional it would be branch plus HO, and for fintechs only the HO. Apart from that, it will also have any underwriting related expenses for the cases which the bank or the NBFC or the fintech chooses to write or not underwrite. It will also have other expenses. For example, we can include depreciation and amortization of the fixed assets within this or the softwares, and any other admin overhead and selling expenses, admin, sales and marketing, etc. So I've clubbed all these expenses into one line item, which is the OPEX. Okay. And this gives me my broad ROA tree. This profit and loss is essentially an ROA tree. And just a note here, all the percentages are calculated on average assets under management of the companies. Basically, assets under management are nothing but the loans which are in the balance sheet. Okay. Now, if I were to prepare a balance sheet of fintech company, there will be one more question that comes up, whether the fintech is an on-book lender only or whether it does off-book lending also. This is where the fintech is becomes a major game changer as well because of its off-book lending. I'll tell you how that works. So let's understand it in more detail. Let me talk about a fintech balance sheet in case of on-book and in case of off-book. Okay, so on-book plus off-book. In case of on-book, the balance sheet will be similar to what we saw in a traditional model. So let me tell you, in case of let's say AUM, I will have 1000 AUM and I will have equity, let's say 200, and borrowings plus including deposits, let's say 800. So I get a total of 1000 crores and 1000 crores, right? This is how a traditional balance sheet would look like, and this is how a balance sheet for a only on book fintech would also look like. But in cases of fintech, they actually may or may not have a NBFC in their name. Let me explain this to you. As per RBI regulations, to do a lending, you need to have a NBFC license. So, understand this concept. There is an NBFC and there is a customer. Now, as per RBI regulations, the NBFC can lend to the customer and the customer has to repay to the NBFC. Okay. But when these fintechs came into play, initially what was happening was that these fintechs were giving money to the customer by borrowing from the NBFC. Then the customer was repaying to the fintech and fintechs were repaying to the NBFC. The RBI then came up with a regulation that this cannot happen. There can be an NBFC, there can be a fintech, there can be a customer, but the money flow will be as it was originally, which means that the customer will take money from NBFC and pay back to the NBFC. The role of the fintech will only be to become an underwriter or intermediator of sorts. So the fintech will go and acquire the customer, underwrite the customer, then pass on this case to the NBFC. The NBFC in turn will give money to the customer, and the customer then repays to the NBFC. And then between the NBFC and fintech, there is monthly or quarterly settlement done as to whatever amount is receivable by the fintech. This is how the actual structure is working. So to beat this, what happened was multiple fintechs actually went and acquired NBFC license. So how did they acquire NBFC license? Either they went and they actually opened up a new company and then acquired an NBFC license, or they went and purchased companies which already had NBFC license. So, in our case, let's assume that if the fintech does not have a, if the fintech is not doing lending from its own book, because in this case, to lend from its own book, there means that the fintech had an NBFC license. But if the fintech is also doing off book, it means that the fintech is using some other lending partner as well. Which means how it works is, let's say if we are doing on book plus on off book both, so there is a customer, there is me, the fintech. Now, if the customer has borrowed, let's say 1000 crores from the fintech, how this would essentially work in a on book plus off book lending structure is, let's assume a 20 is to 80 on book is to off book structure. So the fintech through its NBFC will give the on book part, which is the 200 crore part, and then there will be a lending partner of the fintech. This lending partner means it is either a bank or an NBFC in itself. This lending partner will give the remaining amount to the customer, which is the 800 crore amount. So in the fintech's balance sheet, in case of this case, the AUM will be actually 200 crores only. How did this 200 come? That may be variable, maybe 150 crore through debt and maybe 50 crore through equity. This is how the fintech has done the 200 crore. And for the 800 crores, that becomes an off-book part of the fintech as 800 crores AUM. So when you look at these two balance sheets, in one case the AUM 1000 crores is entirely on book, and in other case there is again an AUM of 1000 crore, but 200 crore is on book and 800 crore is off book. This is how the on book versus off book model works. Okay. Now the next question that might be coming to your mind is, why would this lending partner actually have some sort of arrangement with the fintech, whereas it can directly go and underwrite the customer and give loan to the customer itself? Why does it need to have a fintech layer in the middle? The reason is that, as I told you, there are multiple customer personas. So these traditional banks or the traditional NBFCs which are acting as lending partner to the fintechs, they actually do not want to lend directly to this particular customer segment, and hence they use the fintech route. Let me elaborate. Assume that this particular customer who took 1000 crore actually defaults. Okay. Now if the customer defaults and let's say there is a loss of 8% on this customer, which means 80 crore rupees loss. So had it been a traditional route, lending partner, and let's assume fintech. Okay, had it been a traditional route, the entire 8% loss or 80 crores loss would have been borne by the lending partner himself or itself. But because I just told you about their profit and loss or ROE tree, if the credit cost goes up that much to 5% or 8%, these companies would become loss making because they do not have that bigger risk appetite, because they are lending at lower rates, and that is where they do not have that bigger risk appetite. So that is where the fintech play comes into picture. Now assume they use a fintech route. Okay, within a fintech route, what would happen? This 8% loss would have been borne by the fintech and zero by the lending partner. Okay, if this is the case, then again you might think, then why would a fintech take help of a lending partner when entire loss is being borne by the fintech itself and zero by the lending partner? That is also a good question. And hence they came to a mid route by forming what is known as an FLDG route. FLDG is an abbreviation of first loss default guarantee. FLDG. What happens here is, ideally in the industry there is a 5% FLDG. So in the FLDG route, when the customer makes a 8% loss for the lending business, the first 5% is borne by the fintech and the remaining 3% is borne by the lending partner, because the fintech has given an FLDG or a first loss default guarantee to the lending partner that okay, on whatever loss happens, first 5% will be borne by me. And hence, in this case, if you look at the P&L, the fintech will have a 5% credit loss and the traditional or the lending partner will have a 3% credit loss in their books. I hope this is clear. And now this is the sole reason why the fintech model has evolved, because one of the customer segment they are catering to, that is a high risk, high return customer segment. So that is why the fintech model has come up. And because these models may or may not have an NBFC, that is where the off book lending came up. And to make the off book lending more risk diversified, the FLDG route also came up. And in essence, that is how the fintech models are operating in today's day and age. Now, on the FLDG piece, one more thing. Let's say there is a lending partner. There now within the fintech, there is a tech company and there is the Fintechs NBFC as well, and then there is the customer. Okay. Now the lending partner via the tech company, if it gives loan to the customer, then that is the off-book part. And if the lending company is giving money to the NBFC, which in turn is giving money to the customer, this is the on-book part. Okay. So what I said as FLDG, that happens in case of on-book, and in case of off-book or the tech part, it is known as service deficiency. You might come across this term in a couple of financial statements. That's why it made it more clear. It is known as service deficiency. It is the same as FLDG, wherein the tech company is actually putting in an expense in its profit and loss statement for the loss which the customer has done. But a tech company cannot write FLDG because it is not an NBFC, so it writes it as a service deficiency. It cannot book a credit loss or a NPA indirectly. It writes it as a service deficiency. And what I told you above was the net effect of this particular thing. Now, one last piece of thing. If you think of it, I told you that interest cost in the matrix which we prepared, I told you that there will be a high interest for the low credit score customers versus low interest for the high credit score customers, as we saw here. So, this is what happens. The traditional company will give to the fintech at 10%. This 10% will actually end up becoming the interest cost of the company or the fintech. And then the fintech will lend at 20% to the customers. And what is left with the fintech is the name. This is how this entire thing works. What is the benefit for the fintech? One more benefit is there that without actually taking a significant loan, it can actually have a major loan book. Because, as I told you, let's say this is an on plus off fintech, and we prepared this balance sheet earlier as well. This fintech can actually have a total book of 1000 crore by only having 20% in its book. AUM 20%, which is 200, via an equity and debt of 50 and 150. In this case, if you look at the AUM is to debt ratio, this is 1000 by 80, 800, sorry, which would be what? 1.25x. And in this case, if you look at AUM is to debt, it is 1000 divided by 150 only, which is what? 6 point, I don't know, 6.67x. Just check the calculation once, roughly 6.5x or something. So if you look at this, in a fintech, they are able to maintain a higher book size, higher AUM by taking very low debt compared to a regular or a traditional business where they have to take a higher debt to maintain the same amount of book. Obviously, you will argue that okay, the 800 crore does not lie in its own book, but again, on that 800 crore, this fintech is actually earning money. This fintech is actually earning 20% on that 800 crore by paying 10% to the traditional lending partner. And hence, this fintech is able to make money on 1000 crores by only raising 150 crores worth of debt. Whereas for the same economics, a traditional business has to raise much more debt. And this enables a fintech to scale faster or scale more better way or in a more efficient way compared to a traditional business. Obviously, there are risks associated with it, but this is how the business works. So just to recap, we covered how a traditional business looks, along with the balance sheet and PL of the traditional business. We covered how a fintech lending business looks, along with the balance sheet and P&L of the fintech. Here we covered both on book only, which is not the true essence of a fintech, and we covered the off book plus on book piece, which is the true essence of these fintech companies. Within this on book plus off book, we also covered what is the FLDG or the service deficiency. And lastly, we also covered bits and pieces of how the money flow would look like. Basically, We covered how in a traditional business the bank or the NBFC lends from its own balance sheet directly to the customer, and whereas in a fintech, the bank actually lends directly to the customer, but there is this fintech layer in the middle which actually acquires and underwrites the customer. And then later on a monthly or a quarterly basis, the fintech settles with the NBFC whatever dues have to be paid or received. And that is how this business works. So I hope this particular lending business topic is clear to you. Now, the last leg, because this is such a major business, I also have prepared a financial model from scratch on my other YouTube channel, the link of which I will put in description and pinned comment. You can go and check how to build a financial model for these lending companies as well. There I have assumed that the company is a lending company which is lending from its own book, and I have built model accordingly. So do check that out if you feel it is required or helpful.